Good Monday morning. We are half an hour from the open in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
Our top stories: Asian stocks rising after the Trump administration pauses tariffs on consumer electronics while warning specific duties will eventually be enforced.
Now, China, meanwhile, is hiking its own tariffs to 125% while calling Trump's actions a joke and showing no sign it is ready to negotiate.
Also ahead, President Xi Jinping begins his Southeast Asia trip in Vietnam, calling for deeper ties and warning against protectionism.
And from everything on the ground to up in the sky, footwear to drones, we assess the impact of Trump's tariffs on broader U.S.-China tensions across these different industries.
All right, taking a look at the market action to start the week here. You're seeing a fair bit of green across the screen this morning, but I think it's important to put into the context. Yes, you're getting maybe a bit of a relief rally coming through, but at the same time, traders are still kind of on edge. So the story going into the session today, of course, are these exemptions that President Trump has issued for a range of different consumer electronics. He's saying that those are temporary, but still, that's the reaction you're seeing in the session today. Things to note as well, of course, is really that outlook for U.S. futures. Yes, you've got them looking, again, in positive territory, but we did just see earnings kicking off to end the week as well. And the U.S. banks, three of the biggest, essentially saying and striking a tone of caution, essentially, continuing to see a lot of fluctuations in the bond space and the dollar as well, a little bit under pressure, and actually some traders are starting to look more like to the euro as an area of a safe haven. As I said, it's really that story around the tariff exemptions and taking a look at some of those movers in particular, so suppliers into Nvidia, into Apple as well. We are seeing these green across the screen. A lot of that relief really being felt by Honhai. Of course, it is the biggest assembler of the Apple iPhone. Of course, though, Trump as well saying that this is just a temporary measure and actually more tariffs will be coming within, say, the next 1 to 2 months. What else we're tracking in the session is the outlook for Chinese equities heading into the open this morning. Things to note over the weekend. We had credit data, for instance, doing better than expected in March. Also got the trade figures coming up. Plus, you're also heading into earnings season as well, David.
No, absolutely. Yeah. I think you have CATL coming out with earnings today. I mean, certainly the question mark right now when you look at this drop in equity markets, the perhaps rebound we're seeing today was the drop purely driven or mainly driven by sentiment, and to what extent have fundamentals and to what extent do we have information to extrapolate how fundamentals have changed, right? Now, on that very note, in fact, so a couple of things to note. So we're still on easing watch as far as Chinese monetary policy is concerned. In fact, you look at the financial news, PBOC-backed financial news article that came out on Sunday, and the reason that's important, if it comes out in financial news, it's probably where policy is going to be. But the PBOC may cut rates in the RRR if the trade war hits the economy. We have some data coming through today in the form of trade numbers coming through. It's at the top of the next hour. I believe we'll have the briefing coming out of the Customs Bureau. In terms of changes to market expectations, Goldman Sachs, I would say half an hour back, just dropped this note in our inboxes, dropping and revising lower their targets for MSCI China to now 75. That's over a 12-month basis. Just keep an eye on that. We'll see what happens, of course, at the open. And, of course, within that space, things like Apple suppliers will be very much in focus when things come online here in Hong Kong and up in mainland China. To Bell's point, of course, we are getting a bit of a reprieve there. But to what extent, how long this actually lasts is a massive question mark still.
Yeah, and, of course, it's really that big policy flip-flop and uncertainty that we continue to get from the White House as well. And as we said, President Trump is saying that he's still going to be applying tariffs to things like consumer electronics, phones, computers, I mean, lots of different areas, but essentially downplaying the weekend exemption as sort of a procedural step. Let's get more now with our news desk editor, Jill Desis, also with our Chief North Asia correspondent, Stephen Engel. So, Jill, what exactly is the procedure then if this is a procedural step?
I mean, great question. I think in terms of trying to sort all of this out, I think, first of all, this ultimately just underscores how vast these tariffs really are, even if you're seeing all of these little, wonky procedural things or whatever it is that the Trump administration wants to call it. But at the end of the day, what's happening here is that the Trump administration, it appears, has exempted semiconductors, electronics, these kinds of things from that 125%, giant China tariff. But what they're trying to say is that doesn't mean that these types of products are exempted from tariffs entirely. It seems that instead what they want to do with semiconductor parts and such, and I think this is something that Trump has kind of said himself on the campaign trail earlier, is instead put that in this bucket of more sectoral types of tariffs that we have. So this is something that Trump has already done with autos, soon to be doing, I think, at the beginning of next month with auto parts. It's something that he's talked about with pharmaceuticals, something that he's talked about with and has already implemented when it comes to steel and aluminum tariffs, is sort of take all of those different types of industries and put that in a separate bucket where a different type of tariff rate applies. So when it comes to semiconductors, for all of these things, at the weekend it seemed were exempted from tariffs, there is likely, in fact, it seems almost certain that there is going to be a tariff going into effect for these types of products. But is that going to be 125% on China? Probably not. Probably much lower. But again, I just really think this underscores how difficult it is to kind of parse through all of these things, because you've got so many different types of tariffs applying to so many different types of sectors and also so many different types of countries that even if we've got this, sort of brief reprieve right now, it kind of is unclear where exactly we go from here. And it certainly isn't something that should give a lot of these companies just, sort of overarching relief for the moment.
I mean, Steve will bring in to the confusing element of this. There's also the timeline that we have to sort of just wrap our heads around, right? When you look at the response from China, response to what and when? The response on Friday, calling it a joke, the response on the weekend to the pulling back in Donald Trump. So just help us understand where the response is right now.
First of all, they upped their tariff retaliation to 125, from 84 to 125, to match essentially the Trump administration's 125, not including the 20% for the fentanyl issue. So that's another bucket we need to address separately from this. But on the issue of 125, it's getting to what MOFCOM and Beijing is essentially saying, and they use this word, it's a joke. And it's not even worth lifting that even higher than this. It's already gotten into triple digits here on both sides. So the Ministry of Commerce said the exemptions that they heard about at the end of last week was a small step by the U.S. towards correcting its wrongful action of unilateral reciprocal tariffs. But as we just heard from Jill talk about, it's not an exemption necessarily. It's maybe a recategorization. And it's a critical one because semiconductors, lithium-ion batteries, and essentially, iPhones, lithium-ion batteries, and laptops are the biggest products that China ships to the United States. And those exemptions that we kind of saw the markets respond to on Friday, it accounts for about $101 billion worth of Chinese high-tech exports to the United States. So it's a big chunk. And Apple plays into this as well. So that was a potentially very good news for Apple. But now it's thrown into a little bit more of a confusion because when are these semiconductor or tech-related tariffs going to come and how large are they going to be?
Fantastic. Steve, thank you so much, teams. Stephen Engel there and Jill Dees is there. I get to the point that Howard Lutnick was just making. Let me just underscore that as we go into the open today, that all those products are going to come under semiconductors. We can't be relying on China, he says, for the fundamental things that we need. There we go. It's a statement coming through underscoring that point. Right. Polls closed in Ecuador, presidential elections just over 3 hours back, and we have the opposition candidate now calling for a recount of the votes, declining to concede at this point in time. That's what we know so far. Live pictures, of course, there we go, out of Quito in Ecuador. More on that later on. Right, just counting down to the open of trade, a couple of things to watch. The fix, obviously, given the pullback we're seeing in dollar China, the retracement we're seeing in the basket now at the weakest in about 2 years or so. As we go into the open today futures, as you can see, we are called for a higher open this Monday morning. You're watching The China Show, and good morning.
Well, we are just counting down to the open this morning. Less than 20 minutes to go now, and Chinese equities really starting to, or looking like they're going to be part of the broader theme today, which is slightly risk on, I would say, but certainly there's a lot of hesitancy still because you're seeing that reflected in trading volumes, which are fairly thin today. One of the other stories as well you were talking about at the top of the hour was this cut from Goldman Sachs as well.
MSCI China down to 75 over the next 12 months or so. There have been also some changes, by the way, which we'll get to later on, from several other brokerages in terms of some of the overweights that do make sense at this point in time. BYD, for example, I think Morgan Stanley came out with an overweight call on that stock. So how do you make sense amidst all the noise and moving parts out there, Bill?
Yeah, and also, of course, I mean, that would apply very, very clearly to businesses as well and how they're assessing the head-spinning tariff developments, the impact on supply chains as well. But let's bring in our next guest. Matt Priest is the president and CEO of the Footwear Distributors and Retailers of America. It does represent 95% of total U.S. footwear sales. So you really are accounting for a large part of the market. But what are you hearing from the businesses that you're working with? How are they interpreting this, and how are they thinking about cost of production and cost to consumers as well?
Yeah, thanks for having me on. It's been a very chaotic time, to say the least. And with all of these tariffs that have been put in place over the last few months, and the threat of tariffs and provisions about if it's on the water or not on the water, are we able to ship it without the 145% tariff? It's created a lot of confusion, but I can tell you that we're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a lot of our members saying, you know what, we just can't financially afford to bring product in with 145% plus duty on top of some of these goods. It's not commercially viable. So as of now, there's a lot of wait and see to see what happens, what the president decides to do, and if there's any respite for some of the impact that we've seen on footwear so far.
Hey, Matt, David here. I guess before on that point, just to follow up there, so are you effectively saying we might see a shortage of certain product categories over the short term because of the halt in some of those orders?
I think that's right, David. I think there's a threat to seeing a shortage of certain products because, look, China's our number one supplier of footwear. When I got this job 15 years ago, it was 88% of our volume to the U.S. It's now 56% of our volume. But the fact of the matter is, most of that volume is for price-conscious consumers here in the States. And so it gets to the point where some of our duties prior to even these big tariffs that were put into place were 37.5%, 48%, 67.5%. You put that on top of 145% duty, you can't make it. You can't make money on it. It's not profitable. And so you're just not going to ship it. So yeah, that is, as the weeks and months progress, if this continues, we are concerned about shortages of certain types of shoes, particularly coming out of China.
Can you give us some more context? When you say that orders are being cancelled from China, what percentage or volume? Can you give some greater clarity around that?
Yeah, right now it's only anecdotal. We're actually going out with a survey to our members here next week just to kind of get a little bit more finer point, Annabelle, on the numbers relative to what's been being canceled and still shipped to us. I can tell you of the 2.3 billion pairs that we brought into the U.S. last year, China sent us 1.2 billion of those. So it's a ton of pairs of shoes. What I can also tell you is that there's just a lot of concern in the marketplace. You know, people don't realize there's obviously big corporate importers, American companies that bring in product, but there are also a lot of mom and pop, second and third generation American companies that import in footwear for consumers here of all different stripes. And so when I talk to those owners and those families and those companies, they're the ones I hear the most strain in their voices about. This is a chaotic time for them, and they're just trying to think, how do I make payroll? How do I try to ensure that we're here tomorrow to open up and still do business? And so that's why we're seeing a lot of just pausing on production because, again, we just don't know if you bring those shoes in and there's a 145% tariff on them, will you even be able to afford the cash flow that these importers need just to pay the duty bill, just to get their product in? And the answer to that is probably no for a lot of our companies. So again, it's driving a lot of concern within our marketplace here in the States.
Have you spoken with any of the manufacturers in China to also gauge their reaction?
Yeah, we are connected with actually my counterparts and all the major footwear suppliers all over the world, and we held a call about a week ago where we got on the phone and we just kind of talked through the landscape and how their members, their respective members, were navigating the engagement with the U.S. marketplace. And I can tell you, most of the countries, most of the trade association executives running those associations that represent the manufacturers in our partner countries were voicing concern, and we're talking about canceled or paused orders. Some countries clearly that with the pause on the reciprocal tariffs, the 90-day pause, are feeling a little bit better as of now with the opportunity to ship product to the U.S. But you also have to look at just our internal numbers on the sales side and what demand is doing right now and what consumer sentiment is doing. And so we've seen a dramatic decline in consumer sentiment. If you look at the University of Michigan survey, our own internal sales numbers are showing declines now. So we see an American consumer that's spooked. So even if you have a lower duty rate and you're shipping to the U.S., the consumer right now may not be interested in buying your product because they're concerned about the future of their pocketbook, if you will, and the concern over broader inflation, which we thought we might be out of the woods on. But because of these actions, it looks like it's going to continue to be something that hangs over our head for some time now.
Matt, funny that you mentioned the UMich numbers. I think on Friday, the year-ahead inflation expectation there was somewhat near 7%. I forget the exact number, 40-year high in that. I guess on that very note, and I know this could end up being quite a wide range, if you could just help us understand, how much do prices of shoes go up, given the current settings? And, to what extent can consumers actually purchase those? Because I would imagine there's also this sort of elasticity of demand that's also at play there.
Yeah, it's a good question, and it's a worthy question to think about, David. I mean, look, when we take the consumer price index for footwear, so we take President Trump's U.S. government's own data, and we lay that on top of the price of footwear at the border, there's an unmistakable correlation. As prices go up at the border, no matter what the reason, tariffs, energy, labor, whatever it might be, as those prices go up, guess what? Prices for the consumer go up. And similarly, as they go down, prices go down as well. It's a hyper-competitive marketplace. The margins for most footwear companies are pretty tight. And so our expectation is that we will see prices continue to go up. We actually, in March, saw a dip in prices, which was rare for us over the last few years. And so we've been thinking, is this the calm before the storm? Because it's an inevitable fact, David, as prices go up, and these astronomical tariffs that none of us have seen these levels in our lifetimes. So we really don't know unless you kind of look back at history, like 1930 or 1932 or back in the 19th century of all places. You'll see as prices go up at the border because of imports or because of duties, then they go up for the consumer. So our expectation is that they will go up. Now, it begs the question, what kind of demand will there be if the consumer is spooked, as the University of Michigan poll is showing? I think you're right. It was a reading from 1981. It hadn't been this bad. So we're not quite sure. We have all our eyes on costs, and we'll see how it all plays out.
Matt, what's interesting about the point you just made, I just thought about this, that, the globalization aspect of the supply chain, right? The potential job losses are actually this part of the world, potentially. I want to understand now, have you guys, as a group, been in touch with officials or legislators in Washington? Have you made your case heard, and how is it resonating there?
Yeah, great question. We have. I mean, that's in our DNA. We're an 81-year-old organization based in Washington, D.C. We lobby, that's what we do. We have done a number of different things. We've organized letters from the industry to Capitol Hill. We've sent over 2,000 letters to members of Congress about this, just from the footwear industry. We've been meeting with members of Congress. I can tell you there's concern across both parties around this action. They're hearing from a variety of different industries. I mean, even if you look at domestic producers in the United States, these tariffs apply to all the inputs and components, materials, and machinery that go into producing goods in the U.S. And even when you talk to those who might, in general, support a stronger tariff policy and support the president's action, they're concerned about their consumers. They're concerned about the political aspect of driving up prices. And so we are engaged with Capitol Hill. We're engaged with the administration. And we're also engaged with our trading partner governments as they go in to negotiate potential deals with the administration so that everyone kind of knows where the American footwear industry stands. We've been paying duties since 1930. We have a $4 billion a year duty bill. If these duties go forward as proposed, we'll have a $10.2 billion duty bill annually. So we're very concerned about the added costs and the tax increases, which this essentially is, that is being added to our cost structure, which inevitably impacts our consumers. And as we engage with policymakers, David, I can tell you that they're concerned as well. Even if they don't publicly vocalize their concern, there is a lot of concern behind the scenes.
So what's the most likely outcome then, do you think, Matt? I mean, the US wants to onshore production. Nearly 100% or 99% of the pairs that are sold in the US are imports. What's actually the most feasible scenario here?
It depends on, Annabelle, it depends on the tariffs. If they move forward, let's say they move forward with China and there's continues to be deal struck with the other countries, I can see Vietnam continuing to take market share. I can see Cambodia in particular, which is our -- 4 supplier, growing significantly. And you might even see some movement back into the Western Hemisphere, Mexico with USMCA access to the U.S. market, and maybe some other countries. I do not see a massive reshoring of production to the U.S. We make 25 million pairs here annually to the 2.3 billion we import. So it's a drop in the bucket. While it's important to those consumers who purchase those shoes, we just don't have the capacity, the know-how, and the labor interest of making those types of shoes here. And so our expectation is that it will shift around globally. But right now, we're just trying to catch our breath, tread water, and see where the White House lands with these tariffs.
Matt, well, on that note, I know you're very busy, so we really appreciate you taking the time to speak with us. Matt, have a great week ahead to the extent possible. Matt Priest, their president and CEO at the Footwear Distributors and Retailers of America. Dollar China, 730.18, weakness coming through into currency after an adjustment coming through. We'll get more details on the adjustment because it's important. Context is important here. It is the weakest fix since 2023, but the delta isn't actually as big as the headlines suggest. More on that in a moment, plus a preview of the Open. 6 minutes away, you're watching The China Show.
Showing an update on the Ecuador election now, and the authorities have declared Daniel Noboa, who is a conservative politician there in power since 2023, but he has been declared the winner of the presidential runoff, David.
Yeah, there we go. More on that in a moment, plus the Open in China. This is Bloomberg. Good morning, Hong Kong. Good morning, Greater China. So we're just shaking off the cobwebs from what's really been, well, number one, Coldplay was in town over the weekend, so that's really one big event in Hong Kong. There was also, I believe, the 6th winter coming through in Hong Kong. So a drop in temperatures, a cold front, if you will. Speaking of weather, quite extreme weather in mainland China and parts of mainland China over the weekend. In fact, some of the warnings coming through there, if you were below, I think it was 50 or 60 kilos, you might get swept away by the wind. I'm not exaggerating. That was actually one of the weather warnings as well. And several events were actually canceled because of all the wind storms over the weekend. Weren't they?
Yeah, well, there was supposed to be a robot marathon, but that's been rescheduled to next week. But 50, 60 kilos, I hope that's just kids. It's certainly not me. We got the market open.
Well, it feels like the steak my friend had the other day. In any case, of course, here we go. So, hefty. That's a good way to put it. Hefty gains at the Open here. A reprieve of, to some extent, to what extent it lasts. And I think it's important certainly to note that while the exemptions on things like iPhones, electronics, are, as Donald Trump put it, as Howard Lutnick actually also underscored, is a reclassification under a different bucket that we'll get more details on semiconductors and tariffs within the next 1 to 2 months. So that if that adds some clarity to the timeline of uncertainty, to what extent can markets rally given that as well? Right, Goldman Sachs, MSCI China, flip the boards, reduced their 12-month target on MSCI China coming up on your screens to 75 from obviously a higher level over the next 12 months or so. So still indication, of course, about 7 points to the upside. That's about just over 10% from the current level. We are getting a rally, though, across the board, 3% on Hang Seng Tech. Just a note on BYD getting an upgrade here from Morgan Stanley to, I believe, overweight. Just keep that in mind. And a couple of big movers from the Friday session, the Friday U.S. session, and as you can see, some very big gains there just about across the board. XPeng all the way to Bilibili and Zijin Mining, which is a gold play. A look at risk appetite very, very quickly. U.S. futures, European futures. Asia is looking like this, plus, of course, what you have here as far as the A50 futures are concerned. So it looks like we are still seeing some gains. In fact, Europe looks like to be a very, very good day there. Now, very quickly, we had the fix earlier on from the PBC. Now, this is important, right? It was the weakest fix since 2023. That's the top panel coming through. The bottom panel actually measures the change in the fix from the previous day. So it answers the question, is there any sign of a one-off currency devaluation? The answer is an absolute no. A currency devaluation actually looks like that red circle you see in 2016, 2015. We're nowhere near that. That was, of course, in 2015. So absolute basis, yes, we're weaker. But on a change basis, no, there's nothing to see here, Bill.
There is something to see here, though, in the studio, because we've got Hao Hong. He's the incoming CEO of China-based securities brokerage, Huafu International. Thanks so much for joining us. So I think we can let you actually take the lead here. What do you want to start with? The moves we're seeing in stocks, yuan devaluation. What's top of mind for you?
Yeah, well, I think top of the mind really is, the tariff situation and how it's going to impact the Chinese market. And as we can see, last week was an epic week for the Chinese stocks, right? So Hong Kong stocks suffered a really bad sell-off on Monday, but then we staged a really strong comeback. I think traders are expecting Beijing is going to come up with new stimulus measure, to sort of offset the impact from tariff. But I think so far, there's very scant details being announced, and also the social financing data is actually stronger than expected because the Chinese government is selling more bonds than expected, right? So obviously, physical machine is starting to work. So I think hopefully, with a little bit of steam being let off from the U.S. side, this week we can have an even further rebound from last week's low.
Is the floor in, you think, in markets, Chinese markets specifically?
I would say the 19,000 level for the Hang Seng last week is a really good and a really good entry point with a reasonable valuation as well.
I think traders are also trying to understand the relative strengths of the US and China as we enter in possibly or are in an economic war. And you mentioned treasuries and the tools that China has at its arsenal.
Yeah.
Do you think that they're also intentionally selling their holdings to destabilize?
Yeah, one shouldn't be too surprised to see, right? So, because in this negotiation, China has less negotiation chips than the U.S., right? So, you have to resort to things other than tariff, other than imports and exports to put pressure on your opponent. So I think last week, when the tariff was first announced, the U.S. Treasury actually rallied substantially. I think 30-40 basis points in one day. But then suddenly, there was some sort of a forced selling in the marketplace, and therefore, it probably blow up some basis trade. But I would say that the trigger is actually set off by some Chinese selling as well. Even though they're saying that, most of the Chinese holding of U.S. Treasury, is with the U.S. banks, right? So it's the U.S. banks acting as a custodian for the Chinese holdings. But then at the same time, we all know that there are like lots of Belgian accounts the Chinese government use to accumulate the U.S. Treasury bonds. So you can sell some of those holdings as well. So I think last week has been a very sort of a volatile, epic week for all assets, not just for the Chinese stocks. I think for the U.S. stocks, it went through a tremendous volatility period as well.
Yeah, it was a bit crazy with the VIX above 40, which is really a level that you don't normally see
right.
apart from periods of stress. Well, speaking of the lack of, or the glass is half full on ambiguity, the U.S. president is in fact speaking right now on Air Force One, talking about how the financial system, it's very respected, that there should not be any ambiguity in financial markets. I guess, tell me this then, we've seen several downgrades to Chinese growth, economic growth. I think Goldman Sachs also came out and slashed their forecast. Will there be a hit to earnings in China from this?
Well, I think, one shouldn't be too surprised, right, to see a huge hit on Chinese earnings. I think, if we assume that all the exports to the U.S. go away, right, so then obviously there will be ripple effect on, the factories that is operating here, manufacturing just for the U.S. destination. All right, so one should be too surprised to see 1.5% to 2% hit on the Chinese GDP. Right, so this year we're trying to do 5% growth, and then we have to reduce it to like 3-ish% for 2025. So if so, then many of the export-oriented companies will get hit as well. So I think right now, even though the market is starting to price in this kind of ultimate scenario, but in terms of earning expectation, we're still not seeing analysts downgrading their earnings estimates that much.
Actually, on that point, there's some interesting news out about plans from JD.com, Meituan, Alibaba's Fresh Hippo to try and sell more of their export-oriented products to a Chinese economy.
Well, I think the Chinese government has been trying to stimulate the domestic market for a long time now. I think ever since 2007, right? So the Chinese economy was talking about restructuring towards a consumption-based economy because in so doing, then the economy would be less volatile, right? So it will be less investment-driven. And therefore, the volatility in the GDP growth would be substantially less than before. But then over the past 10, 15 years, for some reason, we're even more export-driven than before. We're even more investment-driven than before. So I think as a result, now we're entering this sort of a tricky period where you have to cope with the pressure from the U.S. And then at the same time, your domestic market isn't fully mature just yet, right? So the Chinese consumption as a percentage of GDP is less than 50%. It's one of the lowest in the world, especially considering now the Chinese per capita GDP is about $14,000 US, right? So it's quite substantial. It can be classified as almost like a middle income country, but then at the same time, for some reason, consumption is still not boosting up.
What would you recommend investors to buy?
To buy
in this market?
Well, I think last week, we were seeing gold, for example, and the gold miners stage a really strong performance. And also the SOEs, right? So the SOEs are going to get subsidies and supports from the government. And also, going forward, after this huge volatility subside, one should be expecting the tech sector should have strong support from the government as well, because that is being regarded as a forefront for U.S. and Chinese competition going forward. So, and that's the reason why, after a huge sell-off last Monday, and then, the Hang Seng Tech Index is staging a substantial rebound.
Yeah.
All right. Hao Hong, you're staying with us. We're going to have more with Hao Hong, the incoming CEO of Huafu International, in just a couple of minutes. But we have just got another update, actually, on these tariffs on semiconductors in particular. President Trump is also saying that he's going to announce the new duties over the next week. This does follow this exemption that we had going into the weekend on consumer electronics broadly. But President Trump pledged to apply tariffs to phones, computers, popular consumer electronics despite that, and he said he'd be taking a look at semiconductors and the whole electronics supply chain in particular. So we'll have more details on that ahead. But you are watching the China show and you are seeing some of these names, BYD, Sunny Optical, AAC, I mean, these are sort of Apple suppliers as well, moving in the green so far this morning. This is Bloomberg.
Monday came early. Oh, my God. All right. So it doesn't feel like we had a weekend. It doesn't feel like we had a commercial break, really. Breaking news, couple of things. The dollar continues to be on offer. Left side Bloomberg Dollar Index. No, in fact, that's both the Bloomberg Dollar Index. So you have an intraday look. You have a sort of multi-year look. The Dixie is actually below 100. We've now actually hit the lowest, the fresh low for the year on the Bloomberg Dollar Index. That's point number one, right? Point number two is Howard Lutnick, before the headlines broke a few minutes back, talked about how, this exemption Donald Trump talked about on electronics as a reclassification under a different basket. So Howard Lutnick actually said that, we will get probably in a month or two details on semiconductor tariffs. Now, we have more clarity on that now. In the next week or so, the red headline that also crossed terminal earlier on, was it a red? Doesn't matter if it's a red headline. It's an important headline. Donald Trump saying that they will announce tariff rates on semiconductors over the next week or so. So that deadline or that timeline is being brought forward. What's interesting is amidst the aversion, the dollar's not catching a bid, but I guess that's a different set of worms we can get into.
It's the big question around the confidence in the greenback as the cornerstone of the global financial system, and you're continuing to see gold that's being bid, for instance, especially after the PBOC added to their gold reserves as well. But Bloomberg Economics is thinking that a full US decoupling of US-China decoupling now looks much closer, as given the latest tit for tat tariff war. Let's bring in our chief Asia economist, Chung Shu, joining us. So talk us through the view. Why have you brought it forward? I mean, I guess there's a lot of headlines that might suggest why, but talk us through the details.
Yes, we're at this point trying to wrap our heads around all the details. The latest exemption is temporary and can only offer a very marginal sort of relief for the Chinese economy. If we look at the effective rates, it's still, based on our calculation, is still above 100%, in fact, above 110%. So that relief is not huge, and the tariff is highly discriminatory, right? It's China's tariff is much higher than the rest of the world. Therefore, we're losing competitiveness quite significantly. So we do see, the impact GDP exposed to exports to the U.S. could be dropping slightly from 2.5% to 2% of GDP or so, but that's still a huge hit for the Chinese economy. And maybe just a week or two so ago, we would have thought the decoupling between China and US is pretty far-fetched. Perhaps today, when we look at it, this idea is less far-fetched than only a little while ago.
Hao Hong is still with us here on set, incoming CEO at Huafu Securities. A question for both of you, really. Financial News, which is a PBOC-backed paper, put out an article on Sunday. When it comes out there, typically that's a leading indicator of what the PBOC is going to do. PBOC may cut interest rates and reserve ratio requirements. They've said that, though, for a few months, and we're still waiting for that action. Right. When do we get that window of aggressive easing coming through?
Well, I think as the tariff picture becomes more clear, then I think, the government should think of some immediate response. I'm pretty sure that they have everything ready, right? So, for example, the way they respond to the tariff initially, right, is by putting it a counter tariff on the U.S. goods. It shows that it's a very comprehensive list. It shows that, the Chinese government has been preparing for such a scenario. I think going forward, since late last year, PBOC has been talking about cutting RRR, cutting interest rate, and also loosening the monetary policy. But I think, right now, the focus really to keep the Chinese yuan steady, right? Because once you get hit by the tariff, and then if capital starts to fly out of the country, right, so it will become very, very messy, very volatile as well. So I think if you cut interest rate and RRR now, it could put downward pressure on the Chinese yuan. So I think that is probably one of the reasons why, they are not cutting it right now.
very much agree with how I think for the PBOC, easing in April is quite important, sending out a very strong signal. We do see at this point potentially a cut in the policy rates and a cut in the RRR, both in April. But what we feel is important is the fiscal side. Fiscal side will have to do the heavy lifting. We expect the government to speed up the stimulus delivery and potentially signaling additional budget to come later in the year. But the moment is really now, because now the public opinion is largely behind the government to strongly push back to the U.S. very strong stance on China. Our pushback is important. It is strong, and the public supports that. And it's important to sustain this sort of confidence in this stance. So that should be backed up by public government support for the economy.
Yes.
You're nodding and share your views, Hao Hong.
Yeah, well, I think, right now what is working for China really is, the US dollar is weakening, right? So it's sort of reversed its traditional safe haven sort of status, right? So it's trading like emerging market currency, right? Because people obviously are losing confidence in the US dollar. So I think, people are probably, swapping their US Treasury holdings for gold, for example, and one shouldn't be too surprised to see, the Chinese yuan probably, despite all the pressures, holding steady, because once you're not holding the US dollars, you have to hold something else, right? So, and also in terms of cross-border trade settlement, close to 50% now is being settled in Chinese currency, right? So, but mostly it's settled with the Middle East countries and also settled with the Russians. But even so, it's close to 50% settlement using the Chinese currency. So I think the Chinese yuan is probably, its position is stronger than before, right? So back then we didn't have much string to pull, but right now we're probably in a much stronger position. And so, as the US dollar weaken, as the US Fed ready to cut its interest rate, the interest cutting window for the Chinese central bank is opening. Right? So, and also, depending on how much impact from the U.S. tariff on the Chinese markets, for example, if we continue to get gigantic volatility like last week, then one shouldn't be too surprised to see an imminent interest rate cut from the PBOC.
Which I guess also helps, to the point you're making, also helps if borrowing costs are falling for the government, right? And I think one of the things that you mentioned, how earlier on, the March credit numbers does indicate a massive buildup and selling of bonds. Do we expect that to continue moving forward?
I would imagine so. So in a way, we've been talking about monetary loosening. So that seems to be coming on stream, and we do see this going forward. And the government could be, as Hao indicated, could have made all sorts of plans, and we do expect stimulus delivery to come up as soon as possible. But we think the visibility of such plans would be quite helpful for the general public to maintain this sort of confidence and sentiment.
Hal, just ask your final thoughts here. I mean, we're very early days into the Trump administration. What's your outlook for the next, say, couple of weeks, month, quarter? Yeah,
well, I think one should be ready for the worst-case scenario, right? It seems to me that the U.S. Trump is really determined to decouple from China, right, and also relocate all the production facilities back to the U.S. and also back to the U.S. allies. So in so doing, the hit on the Chinese manufacturing sector and the export sector can be quite substantial. So I think people should be ready, for the ultimate scenario that is not thinkable even a few months ago.
All right, Hao Hong, really great to have you on this morning. That was Hao Hong, incoming CEO of Huafu International, and of course our Bloomberg chief Asia economist, Chang Shu, as well. Thanks so much for your time this morning. And just as we mentioned as well, more details coming through on the semiconductor tariffs, and President Trump saying that they're going to have flexibility for companies on these duties as well. We are seeing markets fractionally green this morning, but still, lots of uncertainties and thinner trading volumes as well. More ahead. This is Bloomberg. You're watching the China Show, taking a look at some of the semiconductor names this morning. They're looking a little mixed, lower in Japan, for instance, but higher for the names like Samsung, for instance, at the bottom of the screen. While we are getting more details on as these semiconductor tariffs, and President Trump saying that they're going to have flexibility, but we can expect an announcement within days. And he's also denied that there was any sort of exemption for certain electronics announced Friday. That was in a post on Truth Social, but essentially saying that he is going to be looking at the entire semiconductor or electronic supply chain as well. Nothing's off the hook.
Nothing. So wait for the details on that. But I guess it's very difficult to avoid speculating right now to what extent things, how the dust will really settle. The fact of the matter is right now, as far as markets go, relief rally, you could call it that. I think to some extent, tech's on the way up. We're looking at gains in the order of about, let's call it 1 to 2% on the benchmarks across the region. U.S. futures are higher. FTSE futures are higher. European stock futures are better by about 2.5%. So it's looking like a good Monday as far as risk assets go. I neglected to mention this as well, but it's also worth pointing out as we go into the second hour of the China Show, the dollar is on offer substantially, with the Bloomberg Dollar Index now hitting a new low for 2025. And the Dixie has it's now below the 100 handle. More on that in a moment. This is Bloomberg.
Welcome back to the China Show. Taking a look at the Hang Seng here, we are in positive territory, so really just tracking what we're seeing in other Asian equities after we had this reprieve of sorts from President Trump on different consumer electronics. So it is a very, very busy start to the week. What a Monday morning. But really one of the things that's standing out so far, I think, is around the dollar, because we've just seen the Bloomberg dollar gauge extending a decline to a fresh low for the year. But it's really these questions that we're seeing around the status of the greenback as a haven and as a cornerstone of the entire financial system. It's
a very small sample size for this observation, but what the last, let's call it, week and a half has looked like for the dollar. The dollar is down when risk assets are on offer. The dollar is also down as far as the opposite goes. Yep, you're seeing something here, Belle.
No, I was just saying we just had the exports data in yuan terms here.
Okay,
not
here we
in
go.
dollar terms as yet, but January to March, we've seen exports rising
Non-stop.
nearly 7% on the year, actually, and the trade surplus coming in at near 2 trillion yuan. We are as well seeing China reporting faster first quarter growth in the electromechanical product exports category as well. You question how much of that is sort of front loading in that first 3 months of the year to get ahead of these tariffs as well, but they're just some of the figures so far.
We'll get more commentary coming through out of the Bureau of the Customs Bureau, which is set to, if not already holding that briefing that they do hold every time they take us through the trade numbers which have come through. And I guess more context on this is, earlier on we had, of course, one of our previous guests in the last hour talked about how as far as footwear is concerned, and we'll get to the Vietnam and some of the ASEAN parts of the trade conversation a bit later on, they have seen a lot of their members start to halt orders, and concerns over possible shortages in some footwear categories in the U.S. is not an unlikely scenario, given the uncertainty right now, and also given how much really they can pass on to the consumer at 100% tariffs. Right? Again, we can set that aside for now. Just briefly as well, and just to mention, let's take it back to markets, because as we were pointing out, it's quite busy. You have an ECB decision this week. We haven't even talked about the MAS decision coming out of Singapore earlier on, where they eased policy. And I think what's telling about Singapore, too, is when you look at U.S. futures and the Asian equity markets, too, is they've actually now taken the growth forecast for Singapore, which is a very open economy, to 0 to 2% for the year, right? So effectively, the worst case on the base case is no growth in Singapore, negative output gap, so that means inflation is expected to soften even further. We're looking at FTSE futures, of course, pointing to some gains. And I guess back to the observation we pointed out earlier on, as you look at majors, right? Every time risk assets are bid, the dollar is down. Every time risk assets are on offer, the dollar is also down. Euro on your screen is coming through. Dollar yen, dollar Swissy, and also cable with the Bloomberg dollar index hitting the lowest level for the year. Risk reversals are pointing to, options market being the most bearish on the U.S. dollar going back to 2020. And the dollar index is now trading at, let me just give you an exact figure because I've been referencing a below 100 handle on that. Yeah, there we go, 99.51, which is essentially, if I'm not mistaken, that should be the lowest level. There you go. It's the lowest dollar index in 3 years. So the dollar has taken out the low that we hit back in 2023 to now where you are right now as far as this is concerned. But yes, where do we start? Where do we begin? It seems to be, all the headlines seem to be just flowing as well here.
Certainly, and they lead back really to one person, one word, and that is President Trump. It's also what he's doing on tariffs, and he's saying he's still going to be applying them to phones, computers, popular consumer electronics, so downplaying that exemption that he had going into the weekend and also saying that it's a procedural step. Our senior editor, Derek Wallbank, is with us. So, Derek, this is a really tough story to keep on top of. We know that Trump, as well, has just announced in the last few minutes that he's going to be applying or detailing semiconductor tariff rates over the next week. So, bring us up to speed here. What are we hearing?
Well, thank you and good morning. Yes, Donald Trump just talked about this issue with reporters on board Air Force One. Bloomberg was there for that conversation. Look, Trump is saying that there is going to still be some amount of tariffs here, but he's looking at putting them into a sectoral basket rather than a country-by-country basket. Let me break down really quickly what that means. The country-by-country lists that are coming out, especially with China, are a quite large tariff line, right? You have the 20% fentanyl tariffs and then 125% China-specific tariff. All of that kind of goes together and gets placed there. Moving this into a sectoral tariff probably takes that tariff rate substantially down and makes it kind of regardless of where it's coming in. In addition, and I think the big news off of that conversation in Air Force One is that Trump said that he is going to be showing some amount of flexibility in the way that tariffs for consumer electronics like iPhones and things like that are put together. What the word flexibility means in process, it's hard to say right now. But if you do look at the auto tariffs that went out, there were a couple of little carve-outs here and there. One of the biggest ones that he's carved out in some of his tariffs regarding U.S. and Canada, for example, where a lot of this auto supply chain crosses borders multiple times, is for things that are compliant with the USMCA trade deal, right? So when he's talking about the idea of flexibility, what you're sitting there is saying, okay, there may be some things that we can read in here that might have some details that are potentially favorable for your big importers, your Apples and things of that nature. So watch this space in terms of what that exactly means in process. But he did say that's there. The other thing that I would say is that we are waiting to see where that semiconductor tariff is going to be. Trump saying that the rate for that would get announced in the coming week, Monday to Friday upcoming. So we'll wait to see where exactly that rate lands.
Yeah, Derek, to your point, and it's wonderful being in the news business with the technology that we have right now. You were just alluding to some of the headlines which came through about, let's call it an hour back, with Donald Trump speaking to reporters. We're now looking at him just exiting Air Force One, landing, of course, at the Joint Air Force Base in Andrews there, coming out of, in case you missed it, coming out of Florida. In fact, I did see the U.S. president, not personally, I saw it on the feed. He was attending, of course, Dana White's UFC event on Sunday. I believe it was in Miami. Derek, markets, I guess in some ways, given, despite the complications we have with the math in markets, you can boil it down to something very simple. Do things get better or do they get worse? Help me understand that question within the context of Donald Trump saying nobody will be spared. But to your point, Derek, flexibility likely means we will be pulling back from, worst case scenario tariffs. Will things get better or get worse over the next 2 weeks?
I don't know how you could ask me a more broad question. That is the question, isn't it, though, right? And Trump has sought to reassure markets that he's not trying to blow up everything, right? And that he is not some zealot who's trying to do whatever, but he's got an eye on the markets, and that there's going to be a long-term gain. This is kind of the messaging that we see from Trump. Even, you know, he was talking to reporters, as I say, on Air Force One, making some calming statements about the idea that the American economy as itself is you know, in a decent enough position, right? And he's trying to make the argument that the fundamentals here are still pretty good. Now, there's no question that when we started getting that shakiness, sort of the yips in the bond market, if you will, that really was something that made the president pay attention. And I do think that he is very clued into what is going on. He listens when people like Jamie Dimon speak. He is very, very clued into what is happening in the markets. We have seen the administration say they're willing to tolerate some short-term pain for long-term gain, but there is a line to that. And the last thing I'd say, David, is that we've talked before about the idea that Trump tends to land somewhere slightly below his maximalist threats, but somewhere north of nothing. And that's, again, kind of where he's signaling he's going to land here.
Just trying to figure out exactly what that ground looks like, though. That's our senior editor, Derek Warbank, there. And what is so interesting as well to watch is how China reacts to this and the efforts that it makes to court allies and partnerships in this part of the world as well. And we know that President Xi Jinping is due to begin a Southeast Asia trip today in Vietnam. Before his trip as well, he wrote an article for Vietnam's Nam Dan newspaper saying that the trade war will produce no winner, and protectionism as well will lead nowhere. Our two countries should resolutely safeguard the multilateral trading system and cooperate on a cooperative international environment. Let's get more with our bureau chief in Vietnam, Francesca Stevens, joining us. So, Francesca, she's going to be landing today. What exactly are we expecting from the visit?
Yep, Xi Jinping's expected to arrive around lunchtime, and over his two-day visit, he'll hold meetings with top leaders, including Party Chief To Lam, Prime Minister Pham Minh Chinh, and President Long Kong. Now, it's Xi's second trip to Vietnam in less than 18 months. By making Southeast Asia the destination of his first overseas trip this year, the Chinese president is really signaling Beijing's intent to deepen alliances here in response to Donald Trump's tariff threats. Now, in recent years, Vietnam has received billions of dollars of Chinese investments as manufacturers relocated south to avoid tariffs imposed during the first US-China trade war. The economy is heavily reliant on Chinese components and raw materials, and the two sides are working to develop infrastructure to connect them more closely. Chinese investment has poured into the northern industrial parks, where companies like Foxconn and Luxshare have large factories making components for brands like Apple. Over the weekend, we saw the construction ministry vow to speed up progress of 3 railway projects connecting the two countries. This includes the $8.4 billion cross-border railway that will link the northern border city of Lao Cai to Hanoi and Haiphong port city. That's set to be completed this year, and which we expect to be on the agenda during the two-day talks.
Now, Francesca, the complication is to the underlying strategy that Vietnam has pursued, bamboo diplomacy, remaining on good terms with both sides, China and the U.S. Where does the current uncertainty around tariffs and the environment leave that broader strategy?
Yeah, look, the timing is obviously significant, just days after the US put a 90-day pause on the 46% tariff imposed on Vietnam. Now, those steep tariffs have obviously caused alarm and uncertainty for manufacturers here. Exports account for about 90% of GDP, and the US is the largest market. One of the key concerns for US is transshipment of Chinese goods. On Friday, Vietnam announced stricter measures to target what it calls origin of goods fraud, describing it as part of a fight against counterfeit goods labeled as Vietnamese products. Now, that step is widely seen as addressing that key concern from the Trump team, stopping Chinese goods being shipped to the US via Vietnam to sidestep tariffs. When it comes to security, Vietnam shares US concerns about Beijing's increasing assertiveness in the contested South China Sea. In Hanoi, distrust of China runs deep over the territorial disputes there. In recent weeks, we've seen investigations into children's toys and even a milk tea brand for using images that resemble a map used to state competing claims in the contested waters. And in what was seen as an unexpected move in the last few weeks, Vietnam invited China to send military units to participate in the parade at the 50th anniversary of the end of the war later this month. So that was a conciliatory message coming through amid all of that flare-up in tensions.
That was our Vietnam Bureau Chief, Francesca Stevens there. And coming up, we'll be speaking with the China-focused market researcher, Tidal Wave Solutions, and also Eurasia Group, joining us to discuss tariffs and their impact on the global trading system. So we're going to have that deep dive just ahead. You're watching Bloomberg.
I think in the last wave of tariffs being announced, that was not as big as we expected it and as we've seen it in the past. I think people are getting really a bit tired. They don't know, even if something's announced, whether 2 days later it's not changed again. So you really see some fatigue of decision makers in manufacturing and also in the distribution sector.
We're seeing a lot of orders being canceled, particularly on product being sourced out of China. There's a lot of our members saying, you know what, we just can't financially afford to bring product in with 145% plus duty on top of some of these goods. It's not commercially viable. So as of now, there's a lot of wait and see to see what happens, what the president decides to do, and if there's any respite for some of the impact that we've seen on footwear so far.
Some industry leaders there speaking with us earlier on, really how they're being impacted tangibly, given the uncertainty out there around tariff policy and how things are effectively still, companies are still dealing with moving parts. As we try and get our heads around that, the dollar is softer and gold is continuing to hit new highs right now, 32.50 give or take right now on spot gold. That's another record there for the price of bling. Let's deepen this conversation right now. Have a look at supply chains intimately. Joining us now is Lauren Glowman, China Director at Eurasia Group, and also Cameron Johnson, Senior Partner at China-focused market researcher, Tidal Wave Solutions. Good morning, folks, and thank you for taking the time to, I guess, help unpack. Let's see what we can achieve in a couple of minutes here. Lauren, let me start with you. Where's your head at the moment?
Well, gosh, I think uncertainty is certainly the word of the day, if not the word of the year. So looking at this from the outside, I think it's really interesting to see how China's strategy is shaping up. It seems to be a strategy of patience, matching action with retaliation, and courting the rest of the world in anticipation that others are going to be hurt by Trump's trade policy right now.
Cameron, I think we can put the same question to you.
Yeah, I mean, the reality is that much of the zeitgeist of the U.S. now is just kind of is gone. And I think one of the things you see here when you talk to suppliers and buyers is that this essentially gives Asia and Africa to Chinese supply chains an influence, because now as American firms have to focus more on the home market, the companies and organizations with the money to invest in new areas, whether it's new products in Southeast Asia, whether it's going into Africa, that will be mostly Chinese money. And China also has the technology, and they also have the talent and the people to use that. So here on the ground, that's kind of how they're looking at it. I think the other thing is that we haven't really been here before, at least for a century. So there's not only uncertainty, but what is going to happen next? I think Lauren actually pointed that out. We just don't know, and it's causing great uncertainty in the markets.
Cameron, there's something very prescient about that observation that we haven't been in this situation in a century. If you look back, not even a century, look back 50 years, there wasn't a trade relationship to talk about really to the extent that we've seen evolve over the last few decades. So, Lauren, on that note, do we need to prepare? Do companies need to prepare for a almost near complete decoupling on bilateral trade between the two?
Well, frankly, I think the trajectory is well understood at this point, right? This isn't new territory. This is our second trade war under this current president, right? So I think a lot of that, there are no illusions about the direction of travel here. I think what's now become the most difficult and the least predictable element of this is U.S. policy. And that's what's really affecting these broader questions of global trade order, right? Obviously, companies are having a significant amount of difficulty planning 5-10 years out. But there are bigger questions here about what it means for the U.S. to pull back from the global trade system.
Cameron, we were speaking with the Footwear Association from the US earlier as well. They represent more than 95% of the shoe industry across the states. And they were saying that they're already hearing of orders that are being cancelled by companies in China. How are the suppliers in your network or contacts that you have also reacting to this?
Yeah, we're seeing across the board a wholesale canceling of POs, particularly anything in the near future, let's say in Q2. Past that, though, we're seeing a bit of a pause, more of, we'll put some down payment on, but we're not going to fully execute the PO until we have better clarity. So in the supply chains, at least, anything in the next couple of months basically is a no-go, particularly if they don't have any exemptions tied to it. Electronics will be safe, things related to that, but any kind of footwear, toys, puzzles, the things you might buy at a Walmart, even on Amazon, all of that is basically stopping at the moment.
What are you seeing, though, Cameron? Because one of the interesting sort of phenomenons that maybe we're seeing, and we are discussing it at least, are these TikTok videos, essentially, where suppliers are going through and sort of breaking down different products, either from France or the US, and essentially going into the suppliers and how these are made, the costing behind it. What have you seen of this so far?
Yeah, basically what we're seeing is the democratization of sourcing. In the past, you might use a middleman or a trading company to source your products for you, deal with quality control, or go visit the factory, establish those relationships, and then maybe you would come on occasion. But now what we're seeing is just the complete democratization of sourcing products. What we're also seeing, though, with that is the actual breakdown of what it costs. So when people actually realize, wait a minute, I'm paying $40,000 for a bag that actually only totally, with all the bells and whistles, really only costs $2,500. That's a huge dent. And so basically they're also taking the veil off of what actually a lot of companies are doing and the markups involved. And that, I think, ultimately will spur more buyers of general products.
Do you think that that's any sort of effort to erode brand value from Western companies? And is there any sort of coordinated effort as well, if this is sort of a major push to have these sorts of videos showing up in people's sort of discover pages?
No, this has been happening actually for a couple years, and it started when people couldn't come to China because during the pandemic, of course, it was closed down. And so a lot of it was, here's our products, here's what you need to know, we're going to inform you about them. And then it has actually evolved over time. And now what we're seeing is just kind of this. And I don't think it's any effort to degrade brands. I think, though, what we have to realize is a lot of factories are under extreme pressure and stress. And so when your option is, well, I'm just going to shut down the factory and maybe I'll make some cheap TikTok videos and show how this stuff is made and maybe I can drive some business that way, they're always going to make the TikTok videos and try to drive business back to them.
Now, Lauren, I'll bring you in. What realistic options do you think American companies have, or let's call them multinationals have, in trying to, I guess, replicate a synthetic version of the supply chain we have, not just in mainland China, but going through parts of Southeast Asia, parts of South Asia, for example? What are the plan Bs out there that people are talking about?
Well, it's difficult because there had already been a mitigation strategy in place, right? A China plus one, and starting to find third or fourth markets to reroute supply chains. Now, if we're looking at a tariff wall being erected by the Trump administration, that China plus one strategy is effectively closed. And so I think, a lot of this ultimately depends upon where tariff rates rise after the 90-day pause, right? If this is a strategy ultimately that results in a significantly higher tariff rate for trade with China and something that looks more manageable for third countries, then I think multinationals will have a way to understand that strategy and a way to work around it over time time is another important factor here, right? There has to be a decision and a predictable way forward.
And Lauren, I guess just to follow up on that, do companies need to take action right now? Donald Trump's not going to be around in the White House. Let's say he doesn't do a term 3 that he's talked about, because that's a different kind of worms. He's likely not going to be the president after 4 years' time. Can't companies just sit and just wait for things to settle? It does take 5 years to put up a factory.
Many companies can't. And of course, we're talking about multinationals, but Chinese exporters as well, right? Many of these Chinese exporters are going to have to receive significant government support just to be able to maintain employment. And a number of these firms, smaller sized exporters, for example, have never been hit with these de minimis tariffs before. That's going to have tremendous implications on global trade as well.
Cameron, do you see any risk of backlash from other parts of the world, for instance, other countries in Asia, ones in Europe? I mean, one of the risks of this is that as China tries to find new export markets, there's concerns of overcapacity being sent elsewhere. China says that it's, opposes protectionist measures, but at the same time, China has followed protectionist measures.
I think when you look at the export markets, and it was interesting, the call between van der Leyen and Li Qiang last week is that they recognize that they can't necessarily flood the world with capacity that the U.S. can't take. And so one of the things you're starting to see is these negotiations. This is one of the reasons why we think that President Xi is in Southeast Asia this week, is because they recognize that there's a prime opportunity here to take advantage of some of the trade chaos, but at the same time, they can't do business as usual, right? They have to actually invest more locally. They can't flood markets with certain goods. Some products maybe, but the other thing is overcapacity is very much in the eye of the beholder. Some products are just fine in terms of overcapacity because many countries can't produce them. But others, to your point, particularly if there's local industry, they could be harmed. So I think what you're starting to see is the Chinese trade strategy is more, we're going to negotiate on a local level, but at the same time, we're going to try to see where we can actually take these products that aren't going to the U.S. and move them other places, being sensitive to local demands and needs.
That was the Eurasia China Director Lauren Glaubman there, and also Tidal Wave Solutions Senior Partner Cameron Johnson. Thanks very much to both of you for your time this morning as we try and decode and digest all of these Trump tariff news. But we'll have plenty more ahead. You're watching The China Show, and this is Bloomberg.
Right, welcome back. A reminder that it's not even 10:30 in the morning. Monday. Okay, things just get busier from here. Okay, a reminder that we did get the weakest fix since 2023. That's the top panel you see on your screens. That takes you all the way back to about this point. Now, the question really, and we'll get to the Treasury question in a moment, right? What options does China have at its disposal to deal with, negotiations, shelter its economy? Is a one-off currency devaluation part of the options? I mean, it is. Are we seeing any sign of that? No, right? So what you're seeing here is at the bottom is the actual delta of the midpoint from the previous day. So if you get a big change from the previous day, might that then move the range on the currency, right? So the case in point, to take it back to 2013, 2015 was a big one-off, right? Where we went from the exchange rate there to the exchange rate here. While the midpoint is at 2023 lows, it's happened very, very slowly, and you barely even see that from a statistical perspective, right? But again, Belle, that goes into perhaps what's going in China's favor and others is really taking place against the backdrop of a weaker U.S. dollar here.
Yeah, that was one of the really interesting comments from Hao Hong, who joined us earlier this morning, saying that when you've got that dollar weakness, it actually could provide some support to the Chinese currency as well. But just taking a look at that, because just in the last hour or so, we've seen the dollar gauge falling to its weakest level of the year, and lots of questions around its sort of status as a haven asset as well. Let's get more on that. that also the moves that we're seeing in the bond space as well bring on our MLive, or the person who leads our MLive coverage, that's Garfield Reynolds, of course, and also with us this morning is our opinion columnist, Shirley Ren, who thinks that Beijing could be using its massive holdings of US debt as a weapon in the trade war. But Garfield, let's kick off with you and talk us through these dollar moves that we're seeing this morning, the moves in the bond space. What exactly is signaling this, or signaling it, being signaled rather, by those fluctuations?
Yeah, well, it's been very interesting this morning to watch equities, including US futures, climbing to extend some of the gains that took off last Friday. Ultimately, investors are seeing it as a net positive that Donald Trump did adjust what he's doing when it comes to tariffs on electronics. But at the same time, the US dollar is dropping. So that means that investors still remain extremely concerned about the longer-term impact of Donald Trump's trade wars, and it also casts doubt on the sustainability of those equities gains, because the risks are still very strongly there. And what that we have entered a scenario where the US dollar is trading like a risky asset. So when the US dollar falls, that used to be something that was good for stocks. Now it's something that warns stocks that tougher times are ahead. And that's because the ultimate message that Donald Trump's policies are drumming into global investors is that the US wants to tear down the current global financial architecture, and that spreads risks for everybody. It also casts doubt on the greenback's former role as the ultimate haven.
Shirley, let me bring you in with your column. The holdings of, well, China's holdings of U.S. Treasuries peaked, I think, more than 10 years ago, I think, north of 1.3 trillion. Down nearly half, still substantial, 700 billion. Mm-hmm. Take us through your column here today.
So the idea is we have discovered that Donald Trump does not understand the art of a deal, and definitely does not understand the art of war, right? Like last week, his chaotic policy making and the tariff U-turn showed his pain point. He actually blinked, and after saying, the bond market route is a little bit dangerous, right? And these days, Treasury Secretary Scott Bessent, he's spearheading the tariff negotiations, and we all know Bessent cares about the bond yield. He talked about 1 basis point increase in government bond yield will cost the U.S. government $100 billion, right? So that apparently is a pretty important choke point for the Trump administration. And at this point, China doesn't need to sell much at all to create chaos and to force the Trump administration to step back, right? Because everyone knows that the U.S. exceptionalism is falling apart. So you just need to have a little bit bounce back during Asia hours, and then the U.S. will wake up and perhaps step back on tariffs.
So what exactly is the PBOC doing then to sort of manage its foreign reserves?
There's no doubt that PBOC is going to diversify away from dollar holdings. And then in the last 5 months, consecutive 5 months, China has been buying gold, which perhaps propel the rise in gold prices, because when you have a big central bank coming into this market, everyone wants to chase and follow this rally, right? The idea is basically, if the U.S. wants to be an economic island and not trade with China, why does China need to hold so many U.S. dollars, right? And it's just a matter of time that China is going to sell down U.S. treasuries.
Julie Wren, you can check out her column there for Bloomberg clients on the terminal. Of course, it's also on the website if you have an internet connection these days. Julie Wren, thank you so much. And Garfield Reynolds there in Sydney for us. We mentioned gold there. Gold just hitting a new record here, $32.50 right now on the most active contract on the curve. So that's really what continues to be bid amidst really uncertainty. Now, JP Morgan's global head of fixed income, Bob Michel, says he is seeing a deleveraging of positions and warns the U.S. is on the path to a recession.
It's really hard to change the confidence of businesses and households. And hence, that probability of recession is still up there at 60%. It's not 100% because you can see an overwhelming policy response. How many times have we been here during COVID or during the regional banking crisis when for sure we were barreling into recession, but the aggregate policy response was sufficient to stop it? We may see that this time, but for now, we're on path to recession.
Let's bring in Sylvia Sheng now. She's global multi-asset strategist at JP Morgan Asset Management. So do you agree with that view? Do you think that the US is on the path to recession, or do you think there's a way to avoid it?
So I think what Bob was talking about is very important. There's still policy responses that can save us from a recession. For us, I think definitely seeing recession odds as being elevated, but it's also important to note that coming into this whole kind of tariff shock, the US economy doesn't have the usual imbalances in the financial market or the kind of household or corporate leverage. So if we do enter into a recession, we do think it's going to be a relatively shallow one.
And what's the advice then in terms of, the bond yield has steepened for several weeks now to 30 years at, I think, near 5. You have the 2-year at 4. Let's call it 4.5 on the 10-year. How do I think about duration and income, generally speaking?
So I think when it comes to duration, currently we're still modestly overweight duration. But when it comes to the U.S. Treasury market, we do have a preference for the shorter end of the curve. So more the belly 3 to 5 year. As you said, the curve is steepening. We do think there's probably more risks at the back end, given the policy uncertainty, inflation risks. But we do think the Fed will ultimately come in to cut rates as growth weakens and employment picks up. So we do think belly of the curve has more value here.
And are you also looking at sort of corporate credit? And if so, are you more on the high yield or investment grade side?
Yeah, so currently we have a modest overweight U.S. credit. For now, we do think high yield fundamentals, like before the trade war, does seem pretty solid. Coverage ratio is pretty okay. And we're not seeing a lot of issuance needs for this year. And also, when you look at high yield, it's more domestically focused. So compared to IG, they're less exposed to the tariffs.
Equity markets, do they remain? Who knows really how things land this week? But do you think there's a high probability that equity markets volatility comes down?
So we do think, if we're looking at tariffs, are we at peak tariffs? I think that's a key question here. Obviously, a lot of kind of a tariff on, tariff off announcement over the weekend as well. But looking at equity markets, we do think it's going to remain pretty volatile. A lot depends on what's going to come up with the tariff announcement and also other policies as well. Let's not forget, they will be focused on tax cuts and also whether there's more positive stuff coming through from deregulation. So I think it's really a balance of that and also how the economy will go from here, whether we're actually heading into a recession.
What does the dollar gauge look like for you as well? I mean, we've seen it hitting a fresh yearly low, but what exactly is that signaling to you?
So I think it's very interesting when you look at last week, you have the U.S. equities, bonds, as well as the dollar selling off. Pretty rare event, I think, if you look at the past history. So it does suggest to us that investors are demanding a higher risk premium when it comes to U.S. dollar assets. And so we are more cautious on the dollar right now because of the volatility in the market, and also dollar is overvalued. So I think let's not forget about that.
Do we need to rethink longer-term exposure to the U.S. dollar then?
So I think longer term, actually, one of the things we've been talking about for several years now in our long-term capital market assumptions is that the dollar is overvalued and needs to come down. But you need a kind of cyclical catalyst to see that happening. I guess we're probably seeing some of that currently.
What about China markets as well? What are you seeing there, and what are you also advising to clients and looking at yourself?
So I think when it comes to China, clearly also caught up with the whole trade war, and given the very elevated tariff levels, we do think that there is a risk to growth here. But when we look at equity markets on a relative basis, we still like Hong Kong markets because it's cheap. And also, we do think there's going to be more policy response coming through, especially on the fiscal side, that is likely to support the market here.
Do you get questions whether this is a good time? And there's a reason I ask this, because dislocations in markets do give you those opportunities. And then you look in hindsight, I should have done something. is it time to make big bets, or do I need to start thinking about preparing myself to make big bets?
So I think currently, given the volatility, we're definitely not advising clients to take big bets right now. But what we think is important to remember is not a great time to time the market given the volatility of news flow, but it's about time in the market. If you look at past crisis events since 1990, if you invested in a 60-40 portfolio, you outperformed cash 75% of time over a 1-year horizon and 100% of the time over a 3-year horizon. So stay invested probably is the best advice right now.
Okay, Sylvia, fantastic. Have a great week ahead. Sylvia Sheng, their global multi-asset strategist at JP Morgan Asset Management. To Sylvia's point, we're looking at equities bid as we get underway this week. We're about an hour into the session here. Hang Seng Tech off highs, I believe, but still better by, as you can see, 3%. We have now, again, a 5,000 handle on the HS Tech gauge, 2150, 21.5 on the Hang Seng Index. Plenty more ahead. This is the China Show.
Well, this morning we're really just trying to understand the impact of Trump tariffs and looking at a range of different industries. So far we've done the ground, looking at footwear. Now we're going up into the sky and taking a look at drones instead. And this morning we're going to speak with a Seattle-based Brinc Drones that specializes in remote-controlled aircraft that's focused on tactical emergency response as well. So the company says its products are deployed by over 400 public safety agencies globally. But now, of course, as well, it's found itself on China's export control list and is subject to trade sanctions. But let's get more now with the company's founder and CEO joining us this morning, Blake Resnick from the US. So Blake, we were just talking there in the ad break. You do source components from outside of the US. You don't have Chinese components, but still you've got components coming from other parts of the world. So talk to us about the impact of these Trump tariffs and how much it's going to increase the cost of your products.
Yeah, I mean, we've certainly felt an impact along those lines. However, our primary competitor is DJI. They're based in China. And the cost of their drones in the U.S. market have obviously escalated dramatically. So we think overall this is actually a net positive for our business. So, I mean, just break it down for us then, because for people that aren't familiar, of course, DJI controls around 90% at least of the consumer market for drones. So they're a very major supplier. How much more expensive have your drones become, and how now prohibitive are those DJI drones going to be as well for consumers or purchasers from the States? Yeah, DJI really has a monopoly position overall. So they have a dominant position in the consumer space, but they also have a dominant position in the public safety space, which is the industry that we predominantly serve. 90% of the police departments and fire departments in the US that use drones are currently utilizing DJI systems. So yeah, I mean, as I said, we've certainly seen our bill of materials costs escalate by double-digit percentage points, but depending on Trump's actions with tariffs and so forth, I think it's pretty reasonable to expect that DJI will be hit significantly harder than us.
Can I ask you then how expensive have your drones become? I'm very curious if you're saying that it's grown exponentially, the price. What was it before tariffs and what is it now?
I would say, the way we predominantly sell our solution is in a subscription package. So when we sign up a city government somewhere in the United States to a citywide 911 response drone network, they're agreeing to a 5-year subscription with us. In year 1, they get initial delivery of our current generation drones, but then they get upgrades at year 2.5 and 5 of an agreement. They get regulatory assistance to help deal with the FAA in the United States. They get maintenance, training, replacement drones to the extent that those are necessary. So when you actually look at our bill of materials, certainly a lot is associated with hardware and getting parts in order to build our end-use systems. But we also see significant bill of materials costs when it comes to, implementation and support and all of those other areas. So yeah, like I said, I mean, we're seeing a double-digit percentage increase in BOM costs for our actual airframes, but in the context of our full product, that isn't so bad.
Yeah, Blake, David here. That's interesting because the way you're maneuvering the pricing environment out there. I like that, the subscription base, the subscription sort of settings right now. So can you help us understand, well, I guess what your advice would be for, I guess, different corporates who might have a similar price dynamics in their own sectors, for example, how they have to deal and look at that cost, that cost coming in that's going up, and how they're able to then pass it on.
It's so industry specific, right? Because it certainly affects the bill of materials costs of companies like mine, but the competitive dynamic in various industries are also starting to shift around a little bit. So I think there will be winners and there will also be losers. In our case, I think we're a modest winner, but I would say this is all specific enough. It's really difficult to give broad advice. Right. And also, we're in a regulated industry where we can't utilize a lot of Chinese components in the first place. So in some ways, that helped us tolerate all of this to a greater extent than we might have been able to without the regulatory action that was taken 2-3 years ago.
Yeah, also interested in that because it has been that big shift that we're seeing, all that growth and interest in what's called a non-red supply chain, so essentially drones that are made without any Chinese components. How much more interest are you seeing in that, not just in the US, but also in Europe?
Oh, I would say interest in that is escalating dramatically. I mean, Ukraine has proven at this point definitively that small drones are the future of warfare. Like, this is truly a strategically important industry. And any country that plans to have to, or is, in a position where they might have to fight a war at some point in the short-term future, needs the ability to produce these types of systems. And that means companies like ours have to exist in the free world and everywhere else, but also suppliers for companies like ours have to exist in those same places. Because if organizations like Brinc or Skydio in the United States are entirely dependent on Chinese supply chains, and we are put in a position where we have to spool up drone production for some war effort, that's obviously not a very tenable situation. So we're seeing interest from government buyers escalating very much both in the United States and in Europe.
You have been sanctioned by China twice in around 12 months now.
Twice,
are you
yes.
seeing any impact? Are you seeing any impact from those sanctions?
Well, I can't go to China anymore, so that's unfortunate. As far as actual impact to our company, no, we're not seeing very much of that. I would say if we got sanctioned 4 years ago or 5 years ago, it would have been highly disruptive because at that point we did have many Chinese suppliers. But at this point, we've weaned ourselves off of those suppliers to the extent that this hasn't affected our ability to produce drones. And obviously, we don't have Chinese assets. I don't personally have Chinese assets. And we also don't have Chinese customers. So given all of those factors, it really hasn't been such a big deal.
The links to Taiwan, though, do you see any risks of sourcing components from Taiwan? And also, Taiwan as an island is making a big endeavor now to try and replace parts of China's drone ecosystem, particularly for companies or governments that want those non-Chinese or non-red supply chains. Hey, what are you seeing there?
I mean, Taiwan has great manufacturing companies, and they have extensive expertise in all of the industries that you would want them to have extensive expertise in order to build out, drone airframe manufacturing companies and also drone parts supplier companies. So I think it's reasonable that they're investing more in this space, again, especially given everything that's gone on in Ukraine. We work with a number of Taiwanese suppliers. I expect those relationships to continue to develop into the future.
That was the founder and CEO of Brinc Drones there, Blake Resnick. Thanks very much for joining us this evening. And, big focus, of course, really how these Trump tariffs are playing out and the impact that's being felt across a range of different industries.
Yeah, and I think that's a very good conversation, an example, really, that it is possible to be able to navigate these things and actually extrapolate yourself from... in the event we do get into some sort of, almost near decoupling on bilateral trade. I think that's a very good example. But I guess in some cases, as Blake was pointing out, I guess we're in some way forced to do it because of regulation. But it is possible to be able to do that. Right. What are we doing now? We're looking at the Chinese currency. And okay, there we go. 7:31. The reason I bring that up, there's a slight leg of weakness coming through in the last few minutes or so. There is an ongoing briefing still, I believe, across the Customs Bureau talking about how trade and the outlook for trade. So we'll get more lines of that. Plus, of course, on the other side of this break, we'll talk more about Singapore and really this curtain raiser of monetary policy we should expect this week. Singapore eased policy and also ratcheted down their forecast for growth and also effectively inflation. Plenty more ahead. This is Bloomberg. Welcome back. Just briefly running you through the pockets of gains we're seeing right now. EVs are catching a very strong bid. BYD getting an upgrade there from Morgan Stanley. Asia Tech in general is also catching a decently strong bid. This is really, as you know, the tariff conversation pares back a few degrees this week. We do understand, though, as you flip the page, that Donald Trump is talking about how in the next week we will get more details on semiconductor tariffs. So stay tuned for that. Singapore eased policy 0 to 2% is where they expect growth this year. Best case 2, worst case 0 or no growth. It is a good day, though, to be long these assets. I'll leave you with a look at this as we make our way into the thick of Monday. That's it from us here on The China Show. We'll see you all tomorrow.